Professor William Liebenberg's latest GESARA history and timeline entry examines one of the most controversial ideas in modern monetary policy: the revaluation of U.S. gold and the potential emergence of a gold-linked RLUSD stablecoin. This topic matters because it sits at the intersection of sovereign debt, global trust in money, and the future structure of digital finance, and it challenges assumptions many people take for granted about how balance sheets, currencies, and reserves actually work. For decades, the United States has officially valued its gold reserves at just $42.22 per ounce, a number fixed in the early 1970s and never updated. Meanwhile, the real market value of that gold has risen dramatically, creating a massive gap between what sits on paper and what the asset could theoretically represent. Economists quietly debate whether closing that gap through revaluation could materially change the U.S. fiscal position, not through selling gold, but through accounting mechanics. The U.S. holds roughly 8,133 metric tons of gold, the largest official reserve in the world, stored primarily at Fort Knox, West Point, and Denver. On Treasury books, this gold remains a dormant asset, untouched and untraded, yet its suppressed valuation is the foundation of the entire revaluation debate. If repriced closer to modern realities, the balance sheet impact would be enormous, at least on paper. A gold revaluation would not mean returning to a classical gold standard, nor would it require moving a single bar of gold. In theory, it would be an accounting operation where the Treasury updates the book value of its gold holdings, reissues gold certificates to the Federal Reserve at that higher valuation, and receives newly credited funds reflecting the gain. Those funds could then be used to retire debt, reduce interest burdens, or stabilize long-term fiscal credibility without issuing new bonds or raising taxes. However, this is where theory collides with reality. To meaningfully reduce a federal debt measured in tens of trillions of dollars, gold would need to be repriced at levels far beyond today's market price, implying a systemic monetary reset rather than a routine adjustment. Such a move risks inflation, market shock, and a loss of confidence in fiat currency if not carefully managed and transparently structured. The political and legal barriers are equally severe. Congressional approval would be required, coordination between the Treasury and the Federal Reserve would be unavoidable, and global markets would immediately scrutinize the credibility of U.S. gold audits and reserve transparency. Bond markets, currency markets, and global reserve strategies would all react simultaneously, making this a high-risk lever rather than a policy tool used lightly. Importantly, a global gold revaluation would not affect the United States in isolation. Countries with large gold reserves, such as Russia and China, would see immediate strengthening of their balance sheets, reduced dependence on the U.S. dollar, and enhanced leverage in bilateral trade. Gold-rich nations would gain credibility in alternative settlement systems and greater influence in a shifting geopolitical landscape. Central banks worldwide would likely accelerate reserve diversification, increasing gold accumulation and reinforcing long-term demand. In such an environment, gold-holding nations would emerge structurally stronger, while countries heavily dependent on fiat issuance would face growing pressure to adapt. This dynamic naturally feeds into discussions around BRICS-aligned settlement units and alternative monetary frameworks. If a BRICS-backed settlement unit were launched after a major gold revaluation, its credibility would be immediate. A gold-linked reference would make such a unit appear far more stable, encouraging trade in energy and commodities to bypass the dollar without triggering an overnight collapse. Instead, the global system would gradually shift toward a multipolar structure where multiple reserve frameworks coexist. Within this context, the idea of RLUSD evolving toward explicit gold backing becomes theoretically possible, but only under strict conditions. Audited reserves, enforceable convertibility, verified custody, and credible governance would be essential. Markets do not migrate on declarations. They migrate on trust built through transparency and proof. A gold-linked digital dollar that consistently outperformed unbacked fiat alternatives would pressure existing systems. Demand for traditional currency could weaken, bond markets could feel strain, and central banks would be forced to respond. This would not instantly destroy fiat money, but it could dramatically accelerate a long-term transition toward asset-backed digital instruments. In conclusion, revaluing U.S. gold reserves is neither a miracle solution nor a fantasy. It is a powerful, politically explosive option that could reshape balance sheets, strengthen gold-rich nations, and redefine the role of digital currencies in global finance. Used carefully, it could stabilize a strained system. Used recklessly, it could destabilize everything. A gold-backed RLUSD would not replace XRP. It would activate XRP's original design purpose. RLUSD would store value, gold would provide credibility, and XRP would move value efficiently across systems. In a multipolar monetary world, the asset that moves value at scale becomes indispensable, and that role is where XRP ultimately derives its importance.